Before we start looking at how money is actually created, we need to have a quick look at what types of money we use in the economy. Ignoring the shadow banking system for now, there are three types of money that we use. As a member of the public, you will only ever have used two of them. The simplest form is cash. The $1, $5, $10, and $20 bills and coins that most of us have in our wallets. As you probably know, only the government, via the Treasury Mint and the Federal Reserve, is allowed to create these. If you try to make your own at home, pretty soon you'll have the police kicking down your door at 2 in the morning. So now imagine that you need to pay your rent and your landlord has an account with a different bank than you. When you log into your online banking and make the payment to your landlord, your bank has to send money to your landlord's bank to settle and complete the transaction. Of course, the banks don't want to make these payments to each other in physical cash because carrying all this money around is inconvenient, not to mention dangerous, even if they used armored trucks manned by guards with bulletproof vests and helmets. So instead, they use a type of electronic money, which is called central bank reserves. Remember that term because we'll be using it a lot in this video. Central bank reserves are basically an electronic version of cash that banks use to make payments to each other. Central bank reserves are created by the Federal Reserve, and they can only be stored in accounts that banks, and now also certain other financial institutions, have at the Federal Reserve. To get one of these accounts at the Fed, you have to be a bank or one of the other financial institutions now granted access to reserve accounts. So, as members of the public, this is not a type of money we come into contact with. So the first two types of money are 1. Cash, and 2. Central bank reserves. Remember that central bank reserves are like an electronic version of cash that only the banks can use to make payments between themselves or to the Treasury. The third type of money is a type of money that isn't created by the Federal Reserve, the Treasury, or any other part of the government. This third type of money is the type of money that's in your bank account right now. This money is just numbers in a computer system. Bankers and economists refer to this type of money with jargon such as bank deposits, demand deposits, sight deposits, or bank credit. These terms all pretty much mean the same thing, and they're used interchangeably. They might also be referred to as bank liabilities, which is the accounting term, because this money is a liability of the bank to you, meaning it's what the bank needs to repay you at some point in the future. Now, in a legal sense, the numbers in your account aren't really money at all. But despite that, they serve the same purpose and have the same value as the $10 or $20 bills you might have in your wallet. It's this type of electronic bank money that now makes up much of what we typically think of as money in the U.S. economy. And all this electronic bank money is essentially created by banks, as we'll explain now. Okay, back to the numbers in your bank account. These numbers are all created by banks. They were largely created when somebody took out a loan from a bank. Let's see how this happens. A customer, who we'll call Carmen, walks into a Bank of America branch and asks to borrow $10,000 for home improvements. Bank of America runs a quick automated credit check and decides that Carmen is a good bet to keep up payments on the loan. Carmen signs a loan contract promising to repay the $10,000 plus interest over the next 4 years, according to an agreed-upon monthly schedule. This loan contract is a legal contract that binds the customer to make payments to the bank. This means that it is a legal contract that is considered to be worth $10,000 plus the interest. This means it's an asset, and Bank of America can record the loan on its balance sheet. Now, if you haven't come across a balance sheet before, don't worry. It's pretty simple. There are two parts to a balance sheet. One half records all the things that the bank owns. This could be money, financial products like bonds and derivatives, bank buildings, computers, and most importantly, the loans it's made. How can you own a loan? Well, if someone signs a contract promising to pay you money, then that contract is worth something, so it's considered an asset of the bank. In the case of Carmen, the contract that she signs promising to pay the bank $10,000 plus interest over the next few years is considered to be worth at least $10,000 to the bank. So the bank puts an extra $10,000 on its balance sheet like this. Now, what about the other half of the balance sheet? The other half is what's called the liabilities side. This is a record of everything the bank owes to other people. On this side, you'll find all the customers' accounts because, if you remember, the balance of your account is just the numbers showing what the bank promises to pay either to you when you ask for your money back or to whoever you ask them to pay on your behalf. When Carmen signed the contract promising to pay the bank $10,000 plus interest over the next few years, she did it because she wanted some money from the bank. So the bank creates a new account for Carmen, which is linked to her debit card, and types $10,000 into their computer records. This $10,000 is a liability from the bank to Carmen, and it shows up on the other half of the balance sheet. Now, when Carmen goes to the cash machine to check her balance, she'll see $10,000 which she didn't have before. All the bank has done to create this new money was type some numbers into an account. It hasn't reduced the balance of anyone else's account, and it hasn't taken any money from some pensioner and moved it into Carmen's account. So the process of creating bank money, which is the money that the general public mostly uses, is as simple as one customer signing a loan contract and the bank typing numbers into an account set up for that customer. Banks do not lend money that already exists. They profit by charging interest on money they create out of nothing. But what happens if Carmen goes and spends the new bank-created money with a store that has a bank account with a different bank, say Wells Fargo? If this happens, then Wells Fargo will want to see $10,000 of central bank reserves from Bank of America. Bank of America would then need to transfer $10,000 of reserves to Wells Fargo to settle the transaction. Note that from the point of view of Wells Fargo, receiving a transfer of $10,000 in central bank reserves into its account at the Federal Reserve is just as good as Bank of America pulling up in a truck and dropping off $10,000 in cash. It's just more convenient for the banks to use the electronic central bank reserves than to carry around all that cash. Then Bank of America would reduce the balance of Carmen's account by $10,000, and Wells Fargo would add that amount to the balance of the store's account. This process of banks making payments between themselves is called interbank settlement, and it's really important to understand it because it's essential to the way that banks are able to create money. Now, this was a simple example that involved just one payment between two bank customers, Carmen and the store. Only two banks were involved, but in the U.S., trillions of dollars worth of transactions are processed every day through a number of different payment systems, including Visa, MasterCard, and online bank transfers. Now, think back to the days before electronic payments. Imagine if the banks had to wheelbarrow reserves back and forth each time they processed a check. So, in order to avoid this, the banks developed a clever way of simplifying the whole thing. Instead of settling each payment individually, the banks agreed to settle net payments at the end of a given accounting period. For example, imagine a customer at Wells Fargo sends his rent, $750, to his landlord's account at Bank of America. But on the same day, a customer of Bank of America sends his own rent, $800, to his landlord, who happens to be at Wells Fargo. The two payments mostly cancel each other out. So after canceling out, or netting in the official jargon, the only money that needs to be moved is the $50 from Bank of America to Wells Fargo. Banks still do this on a mass scale to this day. Since most payments cancel out in the system, the amount that actually needs to be transferred between the banks at the end of the accounting period is typically just a small fraction of the total value of the payments made. It is with the help of this system of netting out payments that banks can create new money rather than needing to first obtain money in order to lend it out. So, because banks know that any payments they make to other banks are likely to be mostly canceled out by payments coming back to them, they can create virtually as much money in deposits as they like without worrying about first obtaining the money they lend out. Then, on top of this, if they do end up needing more reserves than they have, they can always borrow them from another bank. In fact, the Fed makes sure that there are adequate reserves in the system to ensure that banks will be able to obtain them at the Fed's target interbank interest rate. This is the interest rate at which the Fed wants banks to be able to borrow reserves from each other. And if there is a crisis, and banks don't want to lend to each other anymore because they are afraid the other banks might go bankrupt and not repay the loans, banks can always just borrow reserves directly from the Fed at what's called the discount window, at a slightly higher interest rate. This role that the central bank plays is called lender of last resort because it lends when no one else will. This ability of the banks to obtain the reserves they need, regardless of how much money they create, means that reserve ratios do not restrict bank lending. So, with the central bank's support, what would otherwise be a bit of a high-wire act of making sure inflows and outflows of payments cancel out enough is actually pretty low risk as long as the loans are repaid. The only time that a bank would actually need cash and reserves in an equivalent amount to what they owe to their customers would be if their customers were to panic and all ask for their money back at the same time. This is what happened regularly before the advent of deposit insurance and lender of last resort, and it could bring down a bank very quickly. But now, with these public supports in place, there's no reason for depositors to worry that they won't get their money back, so there's no reason for them to panic and try to get their money out before their bank collapses. These public supports are key in helping the banks to pull off making loans without actually needing to already have the money they lend out and ultimately allow the banks to allocate our government's full faith and credit. So, we give the banks the ability to create deposits that are essentially as good as cash, which they do on a mass scale, largely for uses with little public interest justification. And yet, it's money creation for public spending that is seen as the great inflation threat. If we are concerned about money creation driving excessive inflation, wouldn't it make far more sense to first direct our concerns toward the banks? Our Money is campaigning to change the way money is created, and we need you to get involved. Share this video, join our campaign at ourmoneyus.org/signup to stay informed of our campaign efforts, and follow us on Facebook, Instagram, and Twitter at OurMoneyUS.